Have you ever typed "what is my business worth" into Google and gotten a number back from a free calculator? Throw that number away. It is almost certainly wrong, and in a minute I will show you why. There are only 3 real ways to value a business. A buyer is going to use one of them, not the calculator. I am James Bell. I have sold 5 businesses, and every one of them came down to the same arithmetic you are about to learn. In the next few minutes, I will walk you through the 3 methods a real buyer uses. I will show you which one fits your business, and I will run the actual math on a real example. So the next time someone tells you what your business is worth, you will know whether they are right. Watch what those free calculators do. They take your revenue or your profit and multiply it by one fixed number. Plumbing businesses sell for 1 times revenue, but a buyer does not value your revenue. A buyer values your earnings, the money that is actually left over, and only after they adjust those earnings to see what the business really makes without you and your personal expenses in the mix. 2 plumbing companies can each do $2 million in revenue. One keeps $400,000, the other keeps $90,000 because the owner runs 3 trucks into the ground and pays himself through the company checkbook. Those 2 businesses are not worth remotely the same. Same revenue, completely different value. So before any method, you need one number, your adjusted earnings. When I built my businesses, my mentor drilled one rule into me. Treat yourself as somebody the business merely employs. You take a fair salary for the job you do. The profit belongs to the business, all of it. Most owners do the opposite. They treat the business as a personal piggy bank. And when they go to sell, that habit costs them a fortune because the buyer cannot tell where the owner ends and the business begins. Fixing that on paper is called normalizing your earnings. You start with your profit and you add back the expenses that are really yours, not the business's. That gives you the number a buyer actually prices. If your business is smaller, owner-operated, you are in it every day, then buyers use a number called SDE. Seller's discretionary earnings, that is your net profit plus your own salary, plus your personal perks run through the company, plus one-time costs that will not repeat. Now, if it is bigger, you have a management team, you are not the one turning the wrench. Then buyers use EBITDA, earnings before interest, taxes, depreciation, and amortization. Same idea, but it does not add back a salary for a manager. Because at your size, the business still has to pay somebody to run it. Here is the dividing line that trips owners up. The smaller your business, the more your value rides on SDE and a lower multiple. The bigger and more hands-off it is, the higher the multiple climbs. Let me pause for 1 second. If you want the multiple ranges for your specific industry on one page with the source and the date next to every number, they are in my free playbook. So you are not trusting me, you are trusting the data. It is called the Exit Readiness Playbook. The link is right below. Now, the 3 methods. A buyer leans on one of them, depending on what kind of business you have. Method 1, the income approach. Earnings times a multiple. This is how the overwhelming majority of small and mid-sized businesses get valued. You take that adjusted earnings number and you multiply it by a number that reflects how risky and how transferable your business is. The market sets that multiple. So does your industry and your size. For most owners watching this is the method that values your business. Method 2, the market approach. This looks at what businesses like yours actually sold for recently. Real closed deals, not asking prices. Brokers pull these from databases like BizBuySell and the IBBA. It is the same logic as valuing your house off the 3 houses that just sold on your street. Method 3, the asset approach. Add up what the business owns, equipment, inventory, real estate. Then subtract what it owes. This matters for asset-heavy businesses like manufacturing with a lot of machinery. But for a healthy, profitable service business, the asset method almost always undervalues you because it ignores the most valuable thing of all, the cash your business throws off every single year. Let us do the math on a real one. A residential plumbing company in Ohio. I will use round numbers so you can follow. The owner tells me the business does $2 million in revenue and makes about $300,000. So we open the books. Net profit on the tax return, $300,000. Now we normalize. We add back the owner's salary, $120,000. We add back his personal truck, his health insurance, and his phone, all run through the company, $25,000. And we add back a one-time legal bill from a lawsuit that settled, $30,000. Add it all up. The adjusted earnings are $475,000. See what just happened. The business did not make $300,000 to a buyer. It makes $475,000 because the salary, the truck, the phone, and the one-time lawsuit all come back out. That is normalizing. Now the multiple, a stable, owner-operated home services business this size is trading in roughly a 2.5 to 3.5 times range in 2025. Let us say this one earns a 3.2 because it is clean, it is growing, and it does not depend too much on the owner. 475,000 times 3.2 is about $1.5 million. Now watch what the owner's bad habits would have done if he had never cleaned up those add backs. A buyer prices the same business on $300,000, not $475,000. At the same multiple, that is about $960,000. The exact same plumbing company, a swing of more than $500,000, just in how the earnings were presented. And here is what the calculators never tell you. Size changes the multiple. If that same company grew until it had a real manager and $2 million of earnings, it would not trade at 3.2 anymore. Businesses that size were averaging around 7.5 times in 2025. The bigger and the more hands-off you get, the higher the multiple climbs. So what do you do with all of this? Start with your adjusted earnings. Get them clean and defensible today, not the month before you sell. Then understand that your multiple is something you can build. It goes up when the business runs without you, when your books are spotless, when your revenue is growing and not stuck in one customer. Those are not selling tactics. That is just how you run the business, which is the one idea this whole channel keeps coming back to. Run your business as if you are going to sell it tomorrow. When I sold my last business, 2 buyers bid the price up against each other. And the reason they could is that the earnings were honest and the business did not depend on me. That is the whole game. Next week, I go deeper on the multiple itself. What is normal in your industry in 2026, from plumbing to heating and cooling to light manufacturing, so you can place your own business on the map. Subscribe and that episode finds you. And the playbook with every multiple range and its source is free. The link is right below. I will see you next week.